Good afternoon, ladies and gentlemen. We'll go ahead and get started. My name is Colin Plackey, and on behalf of all of our partners, I'd like to welcome you out today. Now, during the next 30 minutes, we're going to take a close look at an incredible multifamily investing opportunity. This is an actual deal with real investors, and I have not altered any of the original numbers or projected returns for the purpose of this webinar. Now, I'll take the time to introduce myself and my qualifications later on, but first, let's consider the following facts. This 173 unit property portfolio was oversubscribed in just under 6 weeks. That means that savvy individual investors, just like yourselves, reviewed the opportunity and in 5 short weeks chose to invest $2.8 million in this deal. Now understand that's an inflow of almost $600,000 per week. The kind of numbers that only happen when a deal is so obviously and intensely desirable, it sells itself. Also, keep in mind that we have a finite limit to how much capital is required to close a deal, and this opportunity was fully subscribed several weeks prior to closing, which means unfortunately some investors had to be turned away because the raise was complete. Now, the sponsorship team responsible for sourcing and managing this particular deal believed in it so much that they invested $700,000 of their own money in it. That's a quarter of the total capital raise. You talk about having skin in the game with your fellow passive investors and aligning your priorities with your passive investors. That represents a material vote of confidence from experienced professionals who have seen hundreds of deals in the past. But they weren't the only ones who voted with their wallets. The remaining $2.1 million came from individual passive investors, much like yourselves, many of them choosing to invest much more than the baseline capital requirement. So what motivated these savvy investors and real estate professionals to jump at this opportunity and invest before the deal oversubscribed? Maybe it was because their initial investment was projected to be almost doubled within 5 years. Maybe it was the double-digit cash-on-cash returns that this project was slated to return. Or it could have been the fact that this property appraised for almost $2 million over the asking price while the deal was still under contract. I'm probably oversimplifying trying to name just one factor that brought investors out in droves for this project. However, if you're in the market for an investment opportunity that's managed by experienced professionals and that combines strong cash flow, forced appreciation, and truly exceptional year-one tax benefits, then I suspect you'll be overwhelmingly intrigued by what you'll learn in the next 30 minutes as I share the details of this opportunity. Now, before we get started, I just want to reiterate that this is not an active deal. I also want to be clear that not every opportunity will appraise for $2 million above the contract price, but I can guarantee that our upcoming deals will look very similar and will likely be just as attractive to investors, especially those investors that couldn't get in the Lubbock portfolio deal before it was oversubscribed. Now, each deal we source will be underwritten conservatively with a goal to over-deliver to our investors, and will have a combination of strong cash flows, forced appreciation, and tax benefits that our investors have come to expect from our deals. Once again, my name is Colin, and I'll be your guide for this webinar. A little on my background. I graduated from Texas A&M University with a degree in petroleum engineering, and I have over a decade of experience in the oil and gas industry in various engineering and financial roles. Now, I came across multifamily investing because I was fed up with the cyclical ups and downs with the oil and gas industry. Several years back, during an industry downturn, I found myself out of work, and I discovered that my investments in the stock market were essentially useless to me. I mean, sure, they had gone up in value over time, but I had to sell them to keep the lights on when my income dried up. And guess what? When I sold those stocks to cover living expenses, I had to pay 35% capital gains tax to Uncle Sam. That's when I decided to change the way I invest. I needed cash flow to cover bills when times were tough. I wanted appreciation so my investments would grow, and I wanted tax benefits because I was frustrated after paying years of high taxes on my income and my investments. Now, multifamily real estate provided the solution for each of those desires, and I started by making several passive investments in the asset class. Since then, I've invested in just under 1,000 units across 3 states, and I've recently become more active in these investments, joining 2 general partnerships to gain more hands-on experience in the business. Now that I have seen how multifamily investing has transformed my life for the better, my goal is simple. I want to share my knowledge and my experience with other busy professionals who, like me, are frustrated with the volatility of the stock market and are tired of paying high taxes on their investments. My goal is to educate these investors and guide them to a smarter investment and build generational wealth for themselves and their families through multifamily real estate. Now, that's probably enough about me. Let's talk a little bit more about why multifamily investing. I mean, it's virtually impossible to argue that multifamily investing is anything but an extraordinary asset class. It's the everything asset class because even ordinary multifamily deals routinely produce everything you want as an investor, like equity appreciation, like cash flow, and like solid tax benefits, not to mention the potential to use leverage in the form of debt financing, which means that every dollar that you invest goes that much further. There's a reason that once people experience the difference of multifamily real estate investing, stocks, mutual funds, and all the volatility of Wall Street starts to lose their luster. Like I said, this all describes what happens with even ordinary multifamily deals. And unfortunately, that's what most multifamily opportunities are today. Just ordinary, not exceptional, just another syndication bounced around between inexperienced sponsorship teams until finally somebody buys it. But that, however, does not describe the deals that we source and we bring to our investors. And here's why. Mark Kenney, a highly respected and successful Dallas multifamily investor, has an advantage over just about everyone else. Experience. He has over 5,600 units under management and over 20 years of hands-on experience in real estate investing. He's a 2-time best-selling author, and he has a degree in accounting. He's widely considered and respected thought leader within the multifamily industry. All this means one thing. When people have great deals, truly great deals, they reach out to him and leverage his track record and his experience to get the deal closed. That is to say that Mark is strategically positioned to experience a level of deal flow that the rest of us can only dream of. Even so, he will literally review over 100 deals until one catches his eye and stands out to him. Most are ordinary, run-of-the-mill opportunities he's seen a million times. There's nothing exciting or inspiring about them. However, when his partners at Presidio Capital, who I'll introduce later, showed Mark the details on a potential deal in Texas, he quickly realized that this particular deal had the potential to be truly exceptional. One of those golden needles in a haystack of ordinary deals. This particular deal that caught his eye is called Riverstone Park Apartments. So why, out of all the deals that come across Mark's desk, did this one catch his eye? Well, reason number one is the fact that Riverstone Park is currently cash flowing even at low occupancy of 83%. Now, all savvy real estate professionals know that cash flow is a great hedge against risk, and if this deal is able to cash flow at such low occupancy, then certainly there's massive upside potential. Mark and this experienced team know how to increase that cash flow by implementing proven systems. Systems which have been honed and perfected over decades of experience, and systems which will quickly bring the property closer to the market occupancy rate of 93%. This same team has performed a thorough analysis of the competition, and the results clearly show that this property is currently well below where market rent should be for this area. Increased occupancy and bringing rents up to match market rates equals increased income. And increased income equals increased value of the property and increased returns for the investors. But even this potential upside only scratches the surface of the truly massive opportunity here, and that is completely eliminating the competition. Remember, Riverstone Park apartment complex is located right here. Immediately adjacent to Riverstone Park is another complex called Mission Villas. This complex is virtually identical to Riverstone Park in many ways. Both were built in the same year, of similar sound construction and materials, and both complexes even have similar amenities and common areas. Really, the only obvious difference between these two apartment complexes is their size. Riverstone Park is 115 units. Mission Villas is only 58 units. Now, like Riverstone Park, Mission Villas is also currently cash flowing and has a low occupancy of around 79%. Also like Riverstone Park, Mission Villas is collecting fundamentally below market rental rates due to serious competition in the area from, you guessed it, Riverstone Park Complex. For years, the owners of these two complexes have been a race to the bottom to see who could charge less than the other in order to attract the most tenants. And do you know who wins in that scenario? The investors. Because of 2019, thanks to the tireless efforts of Mark Kenny's partners, Tracy Hubbard, Erwin Bullock, and Keely Hubbard, these separate properties were combined into the same multifamily syndication to be operated under the same ownership and management team. Now, I'll introduce these other key members of the team a little later, but here's what you simply must understand that it means for the same team to own both Riverstone Park and Mission Villas. It means two things. First, all at once, the primary competitor for each of those complexes does not exist anymore. Reduced competitive pressure automatically pushes rents higher in the near term and closer reflect market rental rates in the area. The second thing that comes from uniting these two properties under the same management team is dramatically increased property value. You doubtlessly know that when net operating income, or NOI, of a multifamily property goes up, the value of that asset goes up as well. And that is how valuations on multifamily properties are done. Using the most conservative underwriting and valuation modeling, this strategic acquisition is projected to increase the NOI of these two assets by $230,000 per year by year 5. This translates to a property value increase of well over $2.5 million over this short time frame. And a sizable portion of that money is what you, as a passive investor, would earn if you choose to invest in this opportunity. Now, there is much more to tell you about the combined asset and the business plan, and each detail makes this project more and more attractive to investors. Property improvements and interior upgrades, additional cost elimination techniques to reduce overlapping expenses, and overhauling property management are just a few that I can name. We'll dive into these details a little bit later. However, one of the most attractive features is where these properties are located. According to Forbes magazine, this market has an unemployment rate of only 2.9%. This market's cost of living is well below the average nationally, making it a very desirable destination for even more residents. In fact, this market has experienced consistent double-digit population growth for 11 of the past 12 decades since they began tracking population in 1910, including almost an 11.5% population growth since 2010. Among the 35,000 cities in America, Forbes ranks this market number 99 for job growth and number 118 for best places for business and careers. The market I'm referring to is, of course, Lubbock, Texas, the 11th largest city in the Lone Star State. But Forbes magazine isn't the only reputable source doting on this market. Wallet Hub named Lubbock on their 2020's Best Cities for Jobs, and USA Today named Lubbock on their list of Best Cities for Jobs, Social Life, and Affordable Living after college. Job search engine Indeed.com ranked Lubbock number 3 city in the nation for above average employment opportunities and high projected growth. And Smart Asset listed Lubbock among their list of top 20 places millennials are moving. These accolades may come as a surprise to individuals unfamiliar with this market. However, the team behind this project was well aware of the ever-increasing attractiveness of Lubbock, Texas. Now, we've already discussed how Mark Kenny is a well-respected industry thought leader with well over 20 years of hands-on experience investing in real estate. But let's take a moment to introduce the rest of the team. Tracy Hubbard of Presidio Capital spent over 2 decades as a commodities and forex trading fund manager, previously holding Series 3 and 43 licenses. Tracy's real estate experience began in the late 1980s, where he started out owning and managing warehouse storage facilities, and he was instantly hooked on the appeal of income-producing real estate. Because of Tracy's extensive experience in the global interest rate and currency markets, he brings a unique advantage in his understanding of how global interest rates can affect cap rates and financing rates, giving him an edge to the position for investors in the coming years. Tracy is a former United States Marine and a 6th-generation Texan. In recent years, Tracy has watched the financial markets evolve, and he's determined that he needed to diversify himself and his investors by transitioning to opportunities in multifamily properties across the U.S. So he decided to partner with Erwin Bullock, a longtime friend and veteran entrepreneur. Erwin has started, bought, and sold or divested companies in different fields, including contracting construction, transportation, aeronautical engineering, electronics, research and development, restaurants, and real estate. His 30 plus years in construction have encompassed design, installation, remodel, and new construction. He currently owns over 300 multifamily units and plans to continue making strategic acquisitions such as the one we're presenting today. Keeley Hubbard is a managing partner of Hubbard Capital Group. Keeley comes from a diverse background and has gained a unique perspective on both the financial and real estate markets. At 14 years old, she began watching her father trade the commodities and foreign currency markets using nothing but paper charts and a call-in broker before the days of electronic trading. Keeley's passion for the financial markets continued throughout her college years when she worked for a large bond trader in Dallas. Following her TCU graduation, she spent 7 years in the financial education industry as an executive for an international company where she drove unprecedented growth. Keeley has an uncanny ability to cultivate lasting relationships through her incredible interpersonal communication skills. Utilizing this ability, she has built a strong bond with local multifamily real estate brokers, which is of paramount importance. After all, these truly exceptional, needle in a haystack opportunities like Riverstone Park and Mission Villas don't grow on trees. It takes a strong relationship and the ability to deliver results to build the trust required for a broker to send an off-market listing such as these. Even getting sent the best deals before they hit the market doesn't necessarily mean it's a secure enough deal to bring in investors. The team first had to spend literally hundreds of hours researching this deal, poring over the numbers, visiting every unit on both properties, confirming the data, and making sure there would be no ugly surprises. I can tell you from my experience with this sponsor team that among the many reasons one might admire them, one of the best is that they are meticulous. Every I is dotted, every T is crossed, nothing gets missed. And that is why I have no trouble trusting this team with my own personal passive investments. Now that we've discussed the property, the market, and the experienced team behind this project, it's time to take a closer look at the business plan and the goals of this investment opportunity. One of the first priorities is to overhaul and replace the existing property management. We'll discuss this more in a minute, but needless to say, there is a ton of room for improvement here. This overhaul includes eliminating overlapping expenses between the properties to reduce costs and increase revenue. Another key priority is to implement a successful marketing strategy to bring occupancy up closer to the market rate. Fortunately for us investors, these two properties were managed with an unsophisticated mom-and-pop type system. Now don't get me wrong, the previous owners are nice people and generally kept the properties in a nice shape, but other than that, not much was done. This gives the team a great opportunity to improve the systems in place to not only increase occupancy, but also to improve the overall condition of the property. Exterior improvements will upgrade curb appeal and attract more tenants, as well as increase the lifespan of the asset. Interior upgrades will include faux wood floors and a contemporary paint scheme to justify bringing the monthly rental prices closer to the market rate. Most importantly, the team wants to create a better sense of community with thoughtful amenities in common areas. Their experience has shown that a true sense of community has a magical effect of enticing residents to stay longer, which decreases turnover expenses, marketing costs, and vacancy. Creating a genuine sense of community is something most other syndication teams don't even bother to think about. But it is proven time and time again to increase the satisfaction of the residents, which translates to increased revenue and again increased satisfaction of the investors. Now, I mentioned before about the immense room for improvement in the way the property was managed. Part of the problem was the previous property manager was a company who focused on single-family rentals, which is a completely different asset class and managed in a completely different way than multi-million-dollar apartment buildings. They simply didn't have the staff properly trained to manage these complex businesses, nor did they have the property marketing strategies in place to attract quality tenants and maintain high occupancy. This leaves very low-hanging fruit for the new property management company, Mayfair Management Group. Mayfair is a national, full-service, multifamily specific management company with well over 30,000 units currently under management. Including 5 complexes in the Lubbock market, this company knows multifamily, they know the market, and they have the necessary systems and procedures in place to increase occupancy and efficiencies. In fact, they already manage a property just down the street that's sitting at 94% occupancy. As you can see, bringing in professional property management will do nothing but improve the property's bottom line. And ultimately, this improvement will make its way into the bank accounts of our passive investors, which is actually a great segue to talk about the financial projections of this project. The entire goal of this acquisition is to ultimately increase the value of this property. The sponsor team has ran countless numerical models to forecast performance of the property during the life of the project. By implementing the various systems and techniques I've outlined throughout this presentation, these numerical forecasts project a pop in net operated income of $230,000 per year by year 5. That's a whopping 33% increase over the NOI of year 1. This increase in NOI is projected to translate to an increase in value of the asset by well over $2.5 million. Again, these profits will be shared equitably among the passive investors and the sponsorship team. Their goals are aligned with the investors. Now, I don't want to bog us down in the numbers, but I think it's worth pointing out the projected returns investors are slated to make on this project. A 2x multiple on their investment in 5 years, 13% cash-on-cash return, 8% preferred return, meaning the management team does not get paid until they return at least 8% profits to the passive investors. Ladies and gentlemen, these are the type of returns that we as passive investors drool over. But these numbers mean nothing if there's not sufficient data and a competent team to back them up. Speaking of competence, a key priority throughout the modeling and due diligence process is to always be conservative with the underwriting. I cannot stress the importance of this enough. We cannot predict the future, but we can certainly prepare for the worst. When looking at a potential investment, Mark and his team err on the side of caution. What is the break-even occupancy? How many exit strategies are possible? What will cap rates do in the future? These are all scenarios they run in what is known as stress testing a deal. The good news is this deal passed the tests with flying colors. And, as a byproduct of this conservative underwriting, the team fully intends to over-deliver for the investors. Speaking of happy investors, there is one major benefit to multifamily real estate investing that I failed to mention earlier, and this benefit is the incredible tax advantages. Now, the government is dedicated to providing affordable housing to its citizens and therefore encourages investments in real estate. This encouragement is achieved through various tax write-offs, but the most important one to discuss today is bonus depreciation. Bonus depreciation allows investors to collect a portion of the write-offs that would have been spread across the life of an asset and accelerate them to year 1. This is a huge advantage for us passive investors, but unfortunately it won't be around forever. Bonus depreciation is set to phase out by 2023, so there's only a finite window for us to take advantage of this incredible benefit. The amount of depreciation for a property that can be accelerated to year 1 is determined by a very strict and detailed process outlined by the IRS. This process is known as a cost segregation report, or cost seg. Now, prior to even closing on this acquisition, the sponsor team had a preliminary cost segregation report drafted for these exact properties, and the results were favorable, to say the least. The preliminary report indicates a roughly $40,000 tax write-off year 1 for a $100,000 investment. Take a moment to let that sink in. The government is providing a $40,000 incentive to invest in real estate. Last time I checked, E-Trade does not send me a 40% rebate every time I sell a stock. This is why investors rarely turn back to stocks after seeing the tangible and stable returns from multifamily real estate. The cost seg study projects another $29,000 in savings over the remaining 4 years for a total tax benefit of $69,000 during this investment's holding period. Now, I can't claim to be a tax expert, and of course you should have a consultation with your CPA about what these tax benefits mean to your situation. But for me, it means my earnings are multiplied. You simply cannot find this type of benefit at this end of the risk spectrum. I mentioned I'm in oil and gas, and I know there's even better tax advantages available for those investments. However, the risk is off the charts, and quite frankly, very few people have the capital required to invest in that space. As I mentioned at the beginning, this particular deal is not active. It was fully funded and closed in 2019, and the business plan is already being implemented as we speak. We do, however, continuously have similar opportunities in our deal pipeline currently being reviewed and stress tested to see if they meet our strict criteria. Any deal that passes our stringent review will have one thing in common: it will not be ordinary. Now, I can't guarantee that our next opportunity will be a carbon copy of the Lubbock portfolio deal we just discussed. I can, however, guarantee that each subsequent deal that we choose to pursue will be managed by experienced teams with proven track records. The opportunities will be located in attractive markets, and future projections will be conservatively underwritten. That way we can ensure the profitability of the venture, and most importantly, to over-deliver to our passive investors. Remember, the general partnership team is invested right alongside of the passive investors in every single deal. This means that their goals are always aligned with yours should you choose to participate in the next deal. Now, if you're a busy professional worried about the coming volatility in the stock market and frustrated after years of paying high taxes on your investments, I'm here to educate and guide you along the path to transform the way you invest. I want to help you make smarter investments, pay less taxes, and generate a lasting legacy of wealth that multifamily real estate provides better than just about any other investment vehicle. But I can't do it all for you. You have to take the initiative and decide you want to make a change that could transform your life for the better. The first step down this path of transformation is to schedule a brief qualification call with me. I want to make this clear. This investment is not for everyone. We need to take some time to get to know each other to decide whether this investment is right for you and make sure you meet our qualifications to invest with us. I must stress how important this first step is. Due to the SEC, that's the Securities and Exchange Committee guidelines, I cannot even show a potential investor in an active deal until I have established a substantive relationship with him or her. In plain English, you won't qualify for our next investment opportunity unless you take this first step and book a call with me. Simply enter the URL below and you'll be taken directly to my schedule. Now, after we get a chance to know each other, the next step I would suggest is to continue learning everything you can about multifamily investing. I have created some great resources for investors, so be sure to download my Essential Guide to Multifamily Investing. This guide will outline the basic principles and answer frequently asked questions, and I would also encourage you to take an in-depth look at the numbers and underwriting for a deal. I've reviewed and participated in numerous multifamily deals and would be happy to take a deep dive with any potential investor. Another great thing to review would be a private placement memorandum, or PPM. This is the actual legal document drafted by our trusted SEC attorney for each investment opportunity. The PPM spells out every detail of the project, including who the management team is, the project financials, and what you're actually purchasing as a limited partner. It's a lot of information, and it would benefit you to see a PPM on a past deal so that the first time you see one isn't on an active deal. The third step is to be ready to take action. When we do get a deal, limited partner spots get taken up very quickly, and the deal becomes oversubscribed. Out of fairness, it's a first-come, first-served basis, meaning those who wire the funds first will secure their spot in the opportunity. It's imperative that once you decide this is the right investment, that you be prepared to move quickly once a deal goes live. If you want to run things by your CPA or attorney, great, I fully encourage that, but do it now. Want to consult with your spouse or any other decision makers? Of course, that's absolutely necessary, but again, the time to do that is now. Have these conversations as soon as possible, because if you wait until we have a live opportunity, I cannot guarantee how long a limited partnership spot will be available. Numerous times I've seen investors that were qualified lose out on a spot because they weren't prepared to move quickly. I'd like to thank you for taking the time to listen to this presentation, and I hope it brings you a ton of value to you and your investments. I encourage you to take the time to visualize how your life would look with steady, predictable income from passive real estate investments. Please reach out to me with any questions regarding this presentation, and don't forget the importance of scheduling a quick call with me. Thanks again, and have a great day.